G'day everyone, welcome back to Pete's Investing. This video is a follow-up from yesterday's video I posted regarding the CCI1500 indicator and applying a moving average 400 to that CCI1500. That's this little indicator down here. This is a price chart, and here we've got the indicator based on the bottom CCI1500, which shows where to go long and where to go short. So here, for example, at that point, when it breaks below the zero, and it goes into a red line, it shows where you need to go short. You don't go long until it breaks above the zero line again, and you go long at that point there, as an example. Anyway, watch yesterday's video. It's in the link below to get a full rundown on the strategy. So let me first of all go to what I'm going to talk about today. So here we've got the daily chart. This is the US S&P 500. This is the 4-hour chart, and this is the hourly chart of the S&P 500. So I'm showing these three charts together deliberately for this purpose. I'm going to explain now. So we're using the same strategy in terms of entering the trade on the hourly chart. So we're not going to trade the daily or the 4-hourly, we're trading the hourly chart. Now, again, you go long when the moving average 400 of the hourly chart breaks into a positive. You can see there, and also this indicator breaks above the zero line. So where do we go long? Now you'll notice we try to avoid going long in isolation on the 1-hour chart in isolation. So what we're doing, we're using the 4-hour chart and the daily chart as supporting trends. So again, follow the trend is your friend. So what we're looking at here is anywhere from here down, you'll be going short. Likewise, here it's starting to turn down, and here it started turning down. So in other words, on the hourly chart, you wouldn't go long at that point there, because if I keep the cursor there, just look at this point there and this point, you'll see the cursor appear on those charts as well. You can see on the 1-hour chart where the blue line turns up, you're still in a downtrend on the daily chart, and you're still in a downtrend still on the 4-hour chart. So again, that point there, let me draw a little arrow to show you. That point there is the same as that point there, and it's the same as, let me just get that right there, and it's the same as that point there. So you wouldn't go long at that point because we're still in a downtrend there and we're still in a downtrend there. So what we need to do is, because the daily chart is in a downtrend since at that point, we want to choose all the downtrends on the hourly chart which match the 4-hour and the daily. So in this example, let's look at that point there. You can see in the 4-hour chart it's in an uptrend there. Okay, so we don't enter the trade there. We enter the trade when it starts turning red on the 4-hour chart there. You can see there on a daily it's in a downtrend, or on the hourly chart it's in a downtrend. That's where you would go short. You wouldn't go long there, you wouldn't go long at any of those. Let's see how that performs on the hourly chart there. You can see there, you'll potentially go short at that point there as well. You can see there on a 4-hour chart, it's turned red, and on a daily chart, it's turned red as well. So again, what I'm trying to emphasize is, you trade the hourly based on the 4-hour chart and the daily chart in the same trend direction. Let's choose another chart as an example. Okay, this chart is for those of you that are in the Indian market. This is the Nifty, the Indian index. So again, let's look at where we are at the moment. So on a daily, we're in a downtrend. On the 4-hourly, we're in a downtrend. And at the moment on the hourly chart, it's in an uptrend. So if you haven't entered short yet, you'd hang off and you don't enter long. You'd wait for that to go short again until the 4-hourly and the daily continue in a downtrend. So if that started turning down again, you would go short there. Let's go back. Let's see how far we go back here. So it starts turning into a downtrend from that point. So you can see there, you would have gone short at that point there. That matches a short just turning on the daily chart, which is the first chart on the left. And it also matches a downtrend in the 4-hour chart, the middle chart. That's where you would have gone left. You would have gone short. And you would have exited the trade as soon as that started turning up and it went into above the zero on that. That chart, all that chart demonstrates. Let me just explain this chart again. Go back to my previous video to get a full rundown. But basically, this chart indicates. Let's go back to this point here. When it's above the zero, that shows the difference between the moving averages, the moving average 25 and the moving average 30. So as the two lines diverge from each other, that goes into a more positive. So that's where you would enter long in that point there, assuming the daily and the 4 hourly matched the long. And you'd exit the trade when it started turning down. And that starts turning down when the moving averages converge and move closer together. You'd enter the short trade, as in this example here, when it drops below the zero, which means those moving averages are now expanding and moving wider apart, making sure that you want to make sure that you're in a short trade, short period, on the daily and the 4 hourly as well. But that's where you would go short and exit the trade, potentially if the price was in your favor, and you'd exit the trade when the moving averages started moving closer together. Lastly, let's look at the gold chart. Again, this is a daily, 4 hourly and hourly chart. Again, trading the hourly chart only. At this point there, you would have gone potentially short. So let's see where that matches up with the 4 hourly. The middle chart, the 4 hourly, was in a downtrend, and so is the daily chart on the left in a downtrend. So you would have potentially gone short there, and you potentially would have stayed short until today. You would have exited the trade when at that point, when the two moving averages started moving closer together, at that point there in this previous trade. So you would have entered. So you can see here, you would have entered short there, exited, entered short there, exited, entered short, exited, entered short, exited, and so on. So each of those is a trade before it turns green on the short side. Okay, hope that's helped explain another way of looking at trading this strategy, using the daily and the 4 hourly chart to confirm your entries into the hourly chart. Stick around for more videos. If you like the channel, hit the subscribe button, the like button, and the notification bell, and see you in the next video.